Welcome back to the Babalian Money Show, your go-to place for making sense of your dollars and cents. Today, we read tackling a classic investing question that probably every single one of us has faced. You've got a chunk of cash, maybe from a bonus, an inheritance, or just some hard-earned savings. The big question is, what's the best way to invest it? Do you go all in at once, or do you dip your toes in the water over time? This is the great debate of lump sum investing versus dollar cost averaging, or DCA. It sounds complicated, but I promise, by the end of this video, you'll understand exactly what they are, the pros and cons of each, and which one might be the right fit for you. Before we dive in, a quick but important reminder. I'm here to share financial knowledge and insights, but this is not financial advice. Your personal situation is unique, so please consider consulting with a qualified financial advisor before making any investment decisions. All right, with that said, let's get into it. First up, let's talk about lump sum investing. The name pretty much says it all. You have a sum of money, say $12,000, and you invest the entire amount into the market all at once. You buy your chosen stocks, ETFs, or mutual funds on a single day and that's it. You're fully invested. The core idea behind lump sum investing is based on a well-known historical fact. Over the long term, the stock market tends to go up. So, by investing all your money as soon as possible, you give it the maximum amount of time to grow. It's the time in the market, not timing the market philosophy in its purest form. If the market goes up right after you invest, fantastic. Your entire $12,000 starts appreciating immediately. This strategy maximizes your potential gains because every single dollar is working for you from day one. Historically, studies have shown that about 2/3 of the time, lump sum investing has outperformed dollar cost averaging. Why? Because markets trend upwards more often than they trend downwards. Delaying your investment often means missing out on potential gains. And this is but what if the market drops right after you invest? That's the major risk and the biggest psychological hurdle of lump sum investing. Imagine putting your entire $12,000 in, and the next week, the market tumbles 10%. Now, let's flip the coin and look at dollar cost averaging, or DCA, using the same $12,000 example. Instead of investing it all at once, you break it up into smaller, regular investments over a set period. For instance, you could decide to invest $1,000 every month for 12 months. Each month, on a specific day, you invest your $1,000, regardless of what the market is doing, whether it's up, down, or sideways. The magic of DCA lies in how it handles market volatility. When the market is down and prices are low, your fixed amount of money, your $1,000, buys more shares. When the market is up and prices are high, that same $1,000 buys fewer shares. Over time, this strategy can lower your average cost per share compared to what you might have paid if you bought all at once at a market peak. This is the real beauty of DCA. It takes the emotion out of investing. You don't have to worry about timing the market perfectly. You're not trying to guess if it's a good day or a bad day to invest. You just stick to your schedule. This systematic approach helps you build a disciplined investing habit and can significantly reduce the anxiety and regret that can come with investing. If the market drops after your first investment, it's not a disaster. In fact, it's an opportunity. You know that next month, your investment will buy more shares at a cheaper price, which feels a lot better than seeing your entire nest egg shrink. The main drawback of DCA? Potential for lower returns. Remember how we said the market generally trends upwards? While you're drip-feeding your money into the market over those 12 months, the portion of your cash that's sitting on the sidelines, the uninvested money, isn't earning any market returns. If the market experiences a strong upward trend during your DCA period, you'll miss out on some of the gains you would have captured with a lump sum investment. Your money that was waiting to be invested didn't get to ride that wave up. So DCA is often seen as a trade-off. You re-sacrificing some potential upside for downside protection and peace of mind. So, which one is better? lump sum, or DCA? The honest answer is, it depends entirely on you. Let's break down who each strategy might be best for. Lump sum investing is often mathematically superior, assuming you have a long time horizon and the market continues its historical upward trend. If you're a rational, data-driven investor who won't lose sleep if the market drops 20% the day after you invest, then lump sum is probably your best bet. You understand that volatility is part of the game, and you're confident in your long-term strategy. You'd rather maximize your time in the market to capture as much growth as possible. If your primary goal is to maximize your potential returns over the long haul, and you have the emotional fortitude to ride out the bumps, lump sum has the historical data on its side. On the other hand, dollar cost averaging is a fantastic strategy for almost everyone else, and there's no shame in that. If the thought of seeing your investment drop right after you put it in gives you a knot in your stomach, DCA is your friend. It's a powerful tool for managing emotional risk, which is just as important as financial risk. If you're a beginner who is just starting your investment journey, DCA is a wonderful way to get comfortable with the market ups and downs without taking a massive psychological hit right out of the gate. It's also the default strategy for most people who invest regularly through their retirement plans, like a 401k or a Roth IRA. Every paycheck, a portion of your money goes into your investments. That is dollar cost averaging in action. It's automatic, it's discipline, and it works beautifully over a long career. So, the choice between lump sum and DCA isn't just a math problem. It's a behavioral one. The best investment strategy is the one you can actually stick with for the long term. If lump sum investing will cause you to panic sell during a downturn, then it's a terrible strategy for you, no matter what the historical data says. Conversely, if you're comfortable with risk and get frustrated by leaving cash on the sidelines, DCA might feel too slow and cautious for you. You could even consider a hybrid approach. Maybe you invest half of your lump sum now and then DCA the other half over the next 6 months. This can give you a nice balance, getting a significant amount of capital working for you right away while still holding some back to take advantage of any potential dips. Ultimately, the goal is to get your money working for you in the market. Both lump sum and DCA are effective ways to do that. The most important thing is to make a plan and start. Don't let the fear of making the wrong choice lead to inaction, because the biggest risk of all is leaving your money in cash, where it's guaranteed to lose value over time due to inflation. Think about your own personality, your risk tolerance, and what will help you sleep at night. Are you aiming to squeeze out every last percentage point of return, or is your priority to have a smoother, less stressful investment journey? Answering that question will point you toward the right path. And that's our deep dive into lump sum versus dollar cost averaging. I hope this breakdown has made things clear and helped you feel more confident in your next investment decision. Which strategy do you prefer? Let me know in the comments below. I love hearing your thoughts and experiences. If you found this video helpful and want to learn more about managing your money and building wealth, please do me a huge favor and hit that subscribe button. Don't forget to ring the notification bell so you won't miss our future videos. Thanks so much for watching the Babalian Money Show, and I'll see you in the next one.